Today, we're going to break down what hard money lenders actually look at when they analyze a real estate deal. In case you haven't seen our channel yet, I'm Aiden Wong, a hard money lender with RSC Private Lending, who's lent hundreds of millions of dollars to real estate investors over the past few years. Before we get into the specifics, it's important to understand what hard money is and what it isn't. Hard money loans exist outside the traditional banking rules. They aren't bound by the same limitations as banks or conventional institutions. These loans are asset-based and designed for situations where flexibility matters. Hard money lenders will typically look at almost any non-owner occupied real estate deal. That includes land, residential, commercial, and even unique unconventional projects. If the property isn't something the borrower plans to live in and it makes sense as an investment, it's usually fair game for hard money. This is why even experienced investors continue to use hard money. Sometimes they've reached the limits with traditional lenders, other times the deal just needs to close fast, and in many cases, the deal is simply too unique for a bank to understand or approve. The goal of a hard money lender is simple. 1. Lend money. 2. Help complete the project. 3. Get paid back with interest and on time. Hard money lenders are not in the business of taking properties or creating problems. Foreclosures cost time and money, and lenders would rather see a deal succeed so they can move on to the next one. Because of that, the number one thing lenders look at is an exit strategy. So the first question a lender wants answered is, how are you going to pay the loan back? Common exit strategies include selling the property, like in a flip, refinancing into long-term financing for a rental, or 3, completing a phase of development and bringing in new capital. Lenders want to know, is it a realistic exit? Does the projected sale price align with the market? Can the property be refinanced at the expected value? And is outside capital committed and timed properly? A strong, verifiable exit strategy is the foundation of any hard money loan. So the next thing we're going to look at is the loan term, because hard money loans are designed to be short-term bridge loans. Most deals fall within the 12 to 24 month range, though some lenders will go up to maybe even 3 years depending on the situation. These loans are not meant to be permanent financing. They exist to bridge the gap between acquisition and exit. The next important thing to look at is credit history, but not necessarily credit score. Hard money lenders don't focus on credit score the same way banks do, but they do care about credit behavior. They'll review credit reports to see patterns such as payments, bankruptcies, foreclosures, deed in lieu, or even habitual defaults. The lender's concern is simple. Will this borrower make payments on time without creating problems? Hard money lenders may have bare minimum thresholds that they may need met, but it doesn't have as much play as it does in conventional lending. So moving on, the next thing that's important for hard money lenders is the LTV, which stands for loan to value. Hard money lenders typically want to see under 90% LTV on most deals, which means there's a 10% down payment or equity brought in from the borrower, and under 75% ARV, which stands for the after repair value, and this is specifically for fix and flip or development loans. Lower leverage means lower risk, which often leads to better terms. Lenders also prefer projects that can be completed efficiently. Fast timelines reduce stress for both the borrower and the lender. The next thing that we're looking at is timing and execution. Timing matters. Projects that drag on create risk. Lenders want to see clear renovation timelines, realistic scopes of work, and borrowers who finish projects quickly and correctly. The longer a deal takes, the more pressure it creates on everyone involved. So let's talk about what hard money lenders care less about. Compared to banks and traditional lenders, hard money lenders are more flexible about W-2 income, tax returns, length of employment, and the traditional debt-to-income ratios. Even reserves can be flexible. Funds may come from HELOCs or other non-traditional sources. What matters most is whether the deal works and the exit is sound. So of course there are going to be pricing differences, and hard money loans generally cost more than bank financing. The typical pricing for hard money loans going to be somewhere between 9 to 12% for your interest rate and origination fees of about 1 to 3 points. Some private lenders may offer slightly lower rates, but often include additional fees such as underwriting, processing, legal reviews, and administrative costs. When comparing loans, total cost matters more than just the interest rate. Hard money lenders have a much wider lending box than traditional lenders. They often lend on single-family homes, fix and flip properties, rentals, small commercial buildings, even land, or unique and unconventional projects. Hard money shines when a deal doesn't fit neatly into a bank's checklist. If you're looking for a hard money lender, most investors find hard money lenders through local real estate networking events, referrals from realtors and other investors, investor meetups, or being a part of online communities, researching beyond the first page of the search results. Or if you want to make it easy, hard money is what we do, so you can click the first link in the description. Every real estate investor, new or experienced, should understand how hard money works and where to find it. You never know when you'll need speed, flexibility, higher leverage, or a lender who understands non-traditional deals. Hard money exists to solve problems that banks can't. Used correctly, it's a powerful tool that belongs in every investor's toolkit. So if it's something that you want to add or even look at better options, go ahead and click that link in the description and we'd love to chat. Thanks for watching, and I'll see you in the next video.